Southern Fried Finance podcast, where your hosts, Vic and Mike, will cover a host of topics related to small business taxes. They'll also touch on an occasional baseball topic, some college football talk in season, and maybe some out. And obviously, we'll talk about the best fishing spots and our best barbecue joints we've found lately. But it's a tax issue, y'all. So sit back, grab something to drink, and get comfortable, and join us for the Southern Fried Finance podcast. And here's your hosts, Vic and Mike. Hey everybody, I'm Mike Ferris. I've got Vic Rouse here with me. We're going to talk a little bit today about the new deductions that came out of the One Big Beautiful Bill Act that was passed back in July. For background a little bit, I've had my firm here in Longmont, Colorado for a little over 10 years. I've been a CPA for 34, and I work mainly with small business owners, entrepreneurs, some executives in various companies around the country, and a lot of senior citizens as well. So a lot of these deductions are very relevant to my client base, and I think they are to Vic's as well. Hey, Vic, how you doing?
I'm doing great. Hey, thanks, Mike. I'm Victor Rouse. I'm a partner in Rouse, Rouse & Rouse. It's a CPA firm in Eden, North Carolina. My dad started this practice in 1965. My mom is also a CPA. She was originally a math teacher. She became a CPA in the early 80s. And after a couple of years with Coopers and Lybrand, prior to the PricewaterhouseCoopers merger, I came back and joined the family business in 1998. So I have now been practicing for over 30 years. So kind of pretty long time. There's our firm's in Eden. I have a broad mix. I'm 100% tax, but it's a broad mix of tax clients, small business, family-owned business, states and trust, partnerships, S corps, and still do a little bit of large company tax work, which is how Mike and I got together. We've known each other and been working together on various things for over 20 years now.
Yeah,
So
couple decades. So we've seen a few of these tax bills come and go over the years.
Yeah, and it's been fun. Mike and I have enjoyed working together for a long time, and it's going to be fun to do these. So
Yeah, for sure. So these new deductions, we're going to talk about these four in particular. They've got a few things in common that make them kind of worth putting all in one discussion. You've got deductions for overtime, tips, auto interest paid, and then there's a special one for senior citizens. They all are effective in 2025 and they all expire in 2028. So they've got a 4-year life here to talk about. So let's hit this overtime thing first and kind of give us an outline on that, Vic. It's pretty interesting.
Well, the overtime deduction, I think each of these deductions, they're a little bit unusual in that they're not really for AGI deductions or from AGI deductions like itemized deductions. There's
like
something that's a little bit different, new category, and they're going to give us a new form to put it on. Mm-hmm. So there's a new schedule to put these deductions on. But this overtime deduction, we're going to get either $12,500 for a single taxpayer, up to $25,000 for a married taxpayer. Phase out singles started at $150,000 of AGI and married at $300,000. So I think there's significant benefit here for people in certain industries that may be earlier in their careers that are working some overtime and getting paid overtime. But if you think about $25,000 of deduction for overtime on a tax return, that's a lot of overtime. A lot of overtime. That sort of sounds like tax season.
Sounds like working at Pricewaterhouse back in 1992. Yeah.
Yeah. There are some people, though, that their industry, their industries kind of dictate that their work schedules are so erratic that they have periods where they work a lot.
Construction industry guys.
Yeah, exactly.
I got a couple of clients in the oil field services industry, and when they're on a job, they're working, worse than tax season hours, and so they're earning a ton of overtime. So those kind of jobs will really benefit from this. And what's going to be interesting is as we learn more about what overtime really means and the definitions behind this deduction. Companies that are following the rules correctly will benefit their employees. There's probably, though, a significant number of people in the economy that are getting paid overtime in their pay structure, but they are exempt employees, and it's merely a function of how we're compensating them. It's really not overtime under the Fair Labor or the FLSA. I get my acronyms all messed up, but that's one of the nuances of this deduction is qualified overtime is defined as being paid under the FLSA as time and a half on your regular rate for hours worked more than 40 in a week. That's a very specific definition. And there's probably a ton of people in law firms and accounting firms and other architect, service firms that are getting paid an overtime component that may or may not qualify. And and I don't know that we're going to have an easy way to know for 2025. I think for 2026 we'll get some better results from W-2 forms and things. But this is an interesting kind of deduction that's going to create a lot of confusion, I think, for a lot of people.
I think that's a good point, Mike. The Fair Labor Standards Act of, I think it was something like 1935. I'm not an
It
expert in
goes
that
back a
act.
long, long ways.
Long way, long time.
And I don't want to
Um,
get down in the weeds too much on that in this discussion, but it's worth at least raising awareness that there's some nuances to this that are going to make it a little bit confusing based on what people perceive and what reality under law might or might not be. So,
oh, a little bit of practical guidance. IRS came back and said you're going to have W-2 reporting for this qualified overtime beginning in 2026. In
yeah,
2025, employers are encouraged to provide this information
do
to their
something.
employees, but they're not going to get penalized if they don't put it on there.
Yeah.
So,
Well, they didn't pass the law until halfway through the year. So,
right.
what were you tracking up until then? And there's a lot of issues around, and that kind of is a good probably. What else we need to say about overtime?
I think that's probably about it. I
That's
think
probably
I think
covers the
just
big parts.
as far as being able to report it to your employees properly, if you got a payroll system and it's with the payroll provider, the wages and the hours are put in there, that's probably pretty easy to track.
Yeah,
But there are a lot of employers in this country that are still doing payroll in more of a manual way or
yeah,
substantially a manual way where they're calculating what the gross wages are and they and issue checks to their
yeah.
employees
Especially
and
in small business world, especially.
yeah,
Yeah,
so I think there's some employers there that are going to have to do a little bit of work to figure out what they need
something
to
to
tell their employees.
Well, and
So
that's a good, that's something to talk about with our clients in year-end planning, especially our business owners that have some employees that might or might not qualify, and it's worth kind of trying to think about it a little bit ahead of time because it'll
yeah,
become a scramble in April when employees are raising their hand. And
yeah,
so,
yeah.
so moving on, we can talk about tips, and I should have mentioned this with the overtime. The tips and the overtime share, to me at least, a very unique characteristic. When we think about deductions, human beings think about I can deduct something if I've paid for it. And the overtime and the tips are just the opposite. It's a deduction, but it's based on income you received. So it's more of an exclusion if we want to get our grammar, I guess, more correct. But that's a
Right.
bit different to think about. So if you've got this kind of income, you get to deduct it from your tax return. So tips, same numbers as the overtime, 12,500 for a single person, 25,000 for a married couple in the tax return. If you're getting tipped as part of your job and you're in a traditional industry tipped job, this is going to be a big benefit. So the servers, the bellhops, all the taxi drivers, the Lyft drivers, all those folks that we always have historically tipped probably think this is the best thing they've ever heard of.
Yeah, and IRS did release a list
Hmm.
of occupational codes that are eligible for the tip deduction. I think if you're talking about a W-2 employee, you're going to get the number from what's going to be reported to you on the W-2 that was already supposed to be on there. But you've got these other occupation codes,
Yeah,
and they're going to be allowed a deduction too. And they are who you would think they are. They're people that are in uh, have personal service businesses, the massage therapists, the
barbers,
barbers,
yeah,
the guy that
bartenders, yeah,
operates the food truck. So there's going to be some self-employed taxpayers that have Schedule Cs on their tax return. They're still going to have to pay self-employment tax because your income's still subject to FICA
sure.
and Medicare and all of that, employee or an employer, but they're going to get an income tax deduction for those tips. So I think for some of these taxpayers, they need to look at their accounting systems to make sure that that additional income is, they know what it
that
is.
they're
So
that
like,
they're tracking it somehow. Yeah. And that's another thing. They didn't pass the bill till July. So can you go back from January through July 3rd and figure out what your tips might have been from your food truck or your barber shop or whatever you do? Sadly, accountants and financial planners and lawyers, even though we do occasionally get a tip, we're not qualified for this. So
we get no deduction. We will pay tax on it like the
we just
rest of
pay
our
tax on
income.
all of it. But
But
but yeah,
I think like my barber, he gives me a number on his gross receipts. He has a Schedule C with his tax return.
yeah,
I don't know whether he tracks what component of that is his tips or his
right.
gross income, his regular receipts
Well,
from what his
and he may
price
not
is. But
feel like he may not have ever felt like historically there was much need to.
there wouldn't have been. There would have
Not
been.
really. Unless he just wanted to know every
Yeah,
haircut was $10 and I made an extra $5 every time in tip. I mean, he might kind of know that in his head without having a tracking system,
probably.
frankly. So,
Yeah, yeah.
so it's a unique kind of thing that we're not used to. And W-2 folks, the waiters and waitresses that are getting W-2s from their employer, as long as the employer is reporting the tips correctly, then that W-2 is going to have a number on it that we can rely on. The rest of the world, we got to talk about it with our clients. And
Yeah.
so interesting stuff. A nuance here, and this applies mainly in the restaurant industry, I suppose. The excludable or the deductible tips are only the ones that are voluntarily given by the customer. So if you sit down at your table and the restaurant charges a mandatory tip because you got more than 8 people in your party, that part doesn't count unless you over tip over and above that.
Yeah, I think that's a good point, and that will come into play at our local golf club, where tips are automatically included in the bill, and I think that's generally the case at a lot of private clubs.
A lot of
Well,
clubs
that
do that.
portion of the tip is not eligible for the deduction. It's only going to be what additional tip
Yeah.
that you give. So the guy that comes out and wipes down your golf clubs, and you give him a couple of bucks, he can deduct that. The server,
Only
if
if he
you
included it in income.
only be included in income is a very good point. So hopefully they're
He puts those
including it
couple
in
bucks in his
income.
pocket. That doesn't count, right?
That's right. That's right.
You know,
But
and our employers tracking those separately? Is the restaurant tracking, the golf club tracking the extra tip versus the compulsory? Who knows, right?
I really don't know. I never really asked.
It's
I really
never
don't know.
mattered. It never has mattered. And again, they passed the bill halfway through the year, so who knows about the first 6 months?
Right.
And how long did it take to adjust? These are all practical things that, in the grand scheme of things, we got to worry about a little bit. But the main point we're trying to get across is we got some kind of interesting new deductions here that we've never seen before of type and character. So it's worth kind of chatting about and making sure our client base is aware of it. So
I think we can go on to auto interest,
yeah,
Mike.
yeah. And so this gets back to traditional deductions based on things you wrote checks for. Something
Yeah.
we're used to. But again, it's up on the page one of the return, a deduction from income, but not AGI. So
Yeah,
weird placement.
and I think it's a little bit unusual that this one's got a different phase out range than the tips and the overtime. Phase out is at a lower level. It's 100,000 for single taxpayers and
Yeah,
200,000 for married. The deduction is $10,000, whether single or married. The
yeah.
maximum deduction is the same, but the phase out range is cut in half. Why is the phase out range different? It's just a way to make the
Congress
numbers
math,
in the bill work out, I guess. But
congressional
I
math.
think
Yeah,
I think is a $10,000 deduction for the interest on a personal car loan. We're not talking about trade or business. This is just on a
yeah. This is just
personal car loan. Um, it's only for vehicles made in the United States.
yep.
It's uh, does it maybe help push the taxpayer to buy a new car instead of a used car? Maybe,
It
maybe,
might. It might
perhaps,
for some folks. It might move the
perhaps.
needle a little bit. Yeah.
Lease payments do not qualify, so
Right.
it
It's got to
may
be a
push you
purchase.
into making a note payment or an auto loan payment instead of making a lease payment on a car,
Yeah,
perhaps.
that's a good distinction.
Um, but if you're deducting $10,000 of car interest, you've got a big car loan. Um, and, and
Well, that's a good point. Yeah, 10,000 bucks of car interest in a year that's a pretty hefty car payment.
yeah,
And a colleague of mine here in town we were talking about this deduction, and I pointed out the phase out range, and he said, "Well, Mike, if I didn't make 200,000 in my household, I couldn't afford a U.S. made car." And and that's a little tongue in cheek, of course, but it makes a good point. U.S. cars are expensive, and this deduction is trying to address some of that cost, I think, and give some people an incentive to buy a U.S. made car, maybe.
right. I think it's also important to kind of think about, well, how much could it possibly be worth to me? I mean, if you were deducting the maximum of $10,000, and I guess that could be a couple of cars, but um,
You
if
could
you're
have a couple of cars,
deducting,
yeah.
if you're getting $10,000 deduction there, well, because the income phase out ranges, you're at most going to be in a 22% bracket, going to save you $2,200 in tax. That's not insignificant. It's not insignificant
Right.
for people in that income range for sure. But I don't know that it moves the needle a whole lot. But maybe if we're trying to look at a new car versus a used car, we're looking at it to buy or to lease, and maybe that does affect your decision making a little bit.
It's a great example of how Congress tries to use the tax code to push people's behavior in the country.
Yeah,
Buy a
yeah,
U.S. made car, not a foreign made car. Here's an
right,
incentive. Yeah.
right.
Whether it works or not, different stories.
It definitely changes our behavior.
It does.
And
It impacts how we
that's for
think about
sure.
things. Yeah.
That's for sure.
So
We're all motivated to put a few more dollars in our own pockets.
absolutely, yeah,
So,
we generally are.
yeah.
So my favorite deduction of all four of these, because I've got a lot of clients that this is going to benefit. The senior citizen deduction probably benefits my particular client base more significantly than any of the others, just because of the nature of the mix of my clients. Um, Senior citizens have always gotten an extra deduction over and above the standard. If you're over 65 years old, you get an extra $1,600 this year, just like you always have. And for the next 4 years, you get an extra $6,000. So a married couple that are both retirees over 65 get an extra 12,000 bucks in their deductions this year. And this is what was sold in the press as the no tax on Social Security provision. It's meant to protect Social Security income or retiree income. It doesn't really matter where your income comes from. If you're old enough, you get the deduction. So kind of interesting. And it's got phase outs too, right?
It does have phase outs. It phases out
Yeah.
at 75,000 on a single taxpayer, 150,000 on a married. I think it is important to understand this. It doesn't change the way Social Security is taxed. Your Social
Right.
Security is still subject to tax in the same way it was before. There's sort of try to phase in how much of it is taxable. Maximum is 85%. Um, so it doesn't change that part of it. It's just giving you an additional deduction or an additional kind of senior standard deduction. I think that's a good way to describe it. Um, but it's an additional deduction if you're over 65. And it applies whether you've got Social Security on the return or not. It
I
doesn't
was going to make
necessarily
that
tie
point.
to Social
Yeah.
Security income. So you could have taxpayers that are over 65 years old, not yet drawing Social Security. They're still going to get this
They're going to get this
$12,000
deduction.
deduction
Yeah.
on a married return. So
Or people
uh,
that were school teachers their whole life and don't get Social Security because they were in a different kind of state. But yeah, it doesn't matter where your income comes from. If you're old enough, you get an extra 6 grand. So
yeah.
this one, I'm more excited about this one because it's going to benefit a lot more of my clients, and most of my senior services clients are going to be knocking on the door of the phase out, but they're probably not going to be too far above it. So we're going to get a lot of benefit out of this in my office this year.
Well, I'm going to tell you one area that we're already trying to help some clients get some benefit out, and we're in the time of year where we're doing income tax projections,
Yeah,
and
it's
I
planning
have
season. Yeah, it's
it's
football
planning
season
season.
and planning season.
That's right. And so for a lot of taxpayers, maybe they've retired, but they're not old enough to start taking required minimum distributions from their IRA, for a lot of those taxpayers, we look and say, we're in a fairly low tax bracket right now, then
I know
maybe
where you're
let's
going.
convert a little bit
Yeah.
of that regular IRA that you've got or that rollover IRA into Roth IRA, voluntarily pay a little bit more tax now in a low rate, so that we can reduce those required minimum distributions and pay a little less
Yeah.
tax once we get up into our
Once you
mid
get to
70s.
73, yeah.
Yeah,
Well, and this gives you an extra $12,000 a
exactly.
room and a married couple to do that. This is
That's
a
exactly right.
powerful thing. Yeah.
Yeah, yeah. And if you think, okay, well, so what's the $10,000 mean in a Roth IRA? Well, how many years in a row can we do it? Can we
We can do it for
grow a
4 at least.
pile of money? Can we grow this pile of money a little bit to where I have a bucket of money that's growing tax-free and in this Roth bucket? So
Yeah.
then when, I'm 75, 80 years old and I want to take a distribution to go buy a new car or go on vacation or
Or
make a down payment
whatever.
on a retirement home or whatever it is,
Yeah.
that I don't have to go to the qualified money and take more
Take
taxable income out to
taxable
do it.
money. Right. And
So
this
I do
works into
think,
inheritance planning with next generation stuff for folks as well. There's a whole lot of things that this, if you got a married couple, $12,000 is not an insignificant amount of money to think about doing some work with on especially when you got 4 years to play with.
yeah,
So,
yeah,
and who knows what
definitely.
Congress does after 4 years. These kind of things tend to stick around, but I'm not going to be speculative that far out. That's crazy in this environment. So
It is, but I do think, and this is definitely true, if you've been around tax as long as you and I have, um, things that benefit a broad range of the
yeah,
population, um, at moderate income levels tend to stick
tend
around,
to be
whether it's
favorable.
yeah, whether it's a child credit or an increased standard deduction or those types of things.
Right.
Now, things that are more narrow and affect higher income taxpayers, they're a little bit more subject to different changes in the political
They get a little
environment.
more attention, but these kind
But
of benefits that like this that are base level and affect a core group of the population, they tend to be pretty popular in Congress and have a longer life, perhaps. But we'll
I,
see.
I would be very surprised if a subsequent Congress takes a $12,000 deduction away from a married
From
couple over 65 years old with
Can you imagine
income
the
under
ads that would?
$150,000. Once we've given it to them, I think they're going to get used to having it,
Well, they
and it's
are.
going to be hard to take that away.
We'll see.
So
So that's the big four here that we can call them. Overtime tips based on income earned, auto interest based on expenses paid, senior citizens based on just living to 65. So, all of these are favorable things in some way out of this tax bill. So there's a lot of criticism about deficit issues and other things, but from my client-based perspective, these four things are things we can talk about in a fairly favorable way with our clients at least.
I think so too. I think, and I'm excited about doing it as we go through these projections here at the end of the year.
Yeah, this is the time of year when all of this stuff is top of mind, figuring out what's going to happen between now and December.
That's
So
great.
yeah. What else, man?
I think that's it. I appreciate it, Mike. We're getting started in basketball season here in North Carolina, and I think
Tennessee
my
too.
Tar Heels are going to be pretty good. So pretty excited about that. I think Coach Belichick is finally figuring out something with his football team, at least
He may
with
have.
our defense. We're starting to play a little bit better.
Yeah.
We got Wake Forest this weekend. Who's Tennessee play?
Tennessee, we go down to the swamp to pick up
Okay.
Florida. And based on, Vol disappointment syndrome over the years, as bad as Florida looked last week, we are very nervous about that game. So we'll see. I did see a thing this morning that I guess Tennessee is ranked 20th in the country in basketball coming out of the gate here at the beginning, and the guy said, "I don't know. I doubt there are 19 teams better than Tennessee, but I guess that's why we'll play the season and see." So,
Yeah. Yeah.
but
Yeah.
it's
Anyway,
nice to be talked about in both sports like that again these
yeah,
days.
yeah, yeah, yeah. It's good. It's good. All right. Well, that
Well,
sounds
man,
great, Mike. And
have a good weekend.
you too. Bye bye.
Send me. Well,
Well, thanks for joining us, everybody. This has been an episode of Southern Fried Finance, produced by Michael F. Ferris, CPA LLC. Vic and Mike really thank you for being here and hope you can join us again next time.